Hey there, everyone. Today on the final bar, the major averages finishing slightly higher, sort of a digestion day today after yesterday's big rally. Consumer staples ended the day at the top of the leaderboard as Target jumps higher on a nice earnings win. Dave Landry will be joining us, sharing his 3 ways to stay on the right side of the market. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the power of the Stock Charts platform. Stock Charts was created about 25 years ago by our founder, Chip Anderson, really just trying to create a way for individual investors to use the technical analysis toolkit and get better returns, make better decisions, have a better awareness about the markets. And now we've evolved to have shows like the Final Bar, hopefully to fill in some of the blanks for you, to help encourage you to use the Stock Charts platform and to use the technical toolkit with more effectiveness, and also just to make sense of these markets. We try to illuminate the markets and help you make sense of things in uncertain times. Now, a day like today, after a big move higher, which we saw yesterday, if you ask people like me, what usually comes right after that, I would say a digestion day. Think of your big Thanksgiving dinner coming up next week if you have one of those, and think about that after party, right? The afterwards where you're just kind of letting things settle in and sort of, taking a break before you figure out what you're going to do next. That's what a day like today is sort of like. Usually a little lighter volume, usually a little more choppy, and at the end of the day, not a big directional move. And that's kind of how things played out. As we get to our market recap, we'll see this a little bit push higher, a little bit of weakness going into the close, but still finishing up in the green. As we start our market recap, I do want to start with a poll question. We asked you recently, where will Alphabet, ticker GOOGL, be 1 month from today? 10% up, 10% down, somewhere in the middle. 77% of you said at least some bit higher than we are today. I think that tells you a lot about the sort of bullish nature of our viewers and of generally the market participants, right? It's a lot of optimism coming through the course of this week as we've digested yesterday's CPI data, sort of processed this potential for a Goldilocks outcome with the Fed's action today really starting to take hold by slowing some of the inflationary pressures. So overall, most of us thinking Alphabet will be higher. Only a third of us saying at least 10% higher. Let's look at a chart of Alphabet and see how things play out. So I just sort of set this up before the show. We ended the day right around 135, sort of right around there. If you look 10% up, that would take us to a new swing high and really would be putting us in the range of the all-time highs back here at the end of 21, beginning of 22. That puts us an upside target around 148 or so. I'm kind of generalizing here. So, if you're saying at least 10% higher, that's saying Alphabet by year end is going to make a new all-time high. It's interesting. I was actually interviewed earlier today for a media outlet, was asked about, a year-end target for the S&P, and, was asked about the potential to get to 4,800, if not higher. It's possible. It's certainly possible, and much more probable now than it was about a week ago, I would argue, given the strength that we've seen this week. Given the improvement in some of the areas of the market that have been not participating, particularly small caps and underperforming sectors like financials, you're seeing some of these beaten down areas of the market finally start to get a bid. You're seeing more and more breakouts happening. That gives me the confidence that further upside could be had. I would probably agree with the masses and say, I bet a month from now we'll sort of be in this range, around 135 to 148. I think that's fair. Now, only 12% of you said at least 10% lower. Now, a 10% drop in Alphabet between now and year end probably would mean that the market's having a much more 2018 kind of experience than the average year, meaning a weaker November into December. That's unusual, but it has happened. December of 2018 was kind of that low before we rallied in the last 2 weeks of the year. So that would basically make a double bottom type of pattern right around the 200-day moving average into mid-December if we would go down a full 10%. So if you're more bearish than that, that means we undercut that low and really start to show weakness going into the end of the year. I would describe that as a possible but probably improbable scenario because that would again mean a very big change from what we've seen in the last week or two. The beauty of technical analysis, why I appreciate you guys answering that poll question as we continue our market recap, it makes you think. Think about what Alphabet up 10% over the next month would look like. Think about what that would mean for your portfolio, for your money management. Think about a dire scenario and how that might play out. All of those 4 scenarios are possible, but think about what they might mean for you and your portfolio. Continuing on to our market recap, S&P, NASDAQ finishing slightly in the green. We don't really show our returns here as a heat map, but if we did, these would be the lightest greenish shade, right? Just sort of that, just barely above zero. The S&P finishing just above 4,500, Nasdaq Composite just above 14,100, and the Dow almost getting above 35,000 at the close. Finished up about 0.5%. And the fact that the Nasdaq is just slightly positive and the Dow is up 0.5%, again in one day, sort of showing this, I think, rotation that we're seeing. As we look at some of the leading sectors, it's not the FANG sectors at the top of the list today. It's some defensive stuff. It's some value-oriented stuff. And that's what's allowing sort of the non-tech heavy Dow to be the top performer of those three today. It's funny, as a market indicator, just looking at the returns on the Dow, S&P, on NASDAQ, I would argue on any time frame tells you a lot about growth versus value. There's your relationship because you have very growth-heavy NASDAQ, very value-heavy Dow, and then the S&P still growthy but less growthy than the NASDAQ. That's a great way to just think about those relative performance trends. Mid caps and small caps all finishing in the green today. The only red you see on the front here is the VIX, which is essentially flat from yesterday's close. We talked about the VIX coming down from just over 20, which was a significant signal it seemed at the time. And all of a sudden dropping back to the low teens. We're back in the range we were in the first half of this year, back in sort of that low volatility bullish range where the VIX tends to settle in. Again, that tells you a lot about how this market has changed. Arguably quite a change of character we've seen here in the last couple of weeks. Interest rates actually moving higher today. Yesterday you saw bond prices rallying pretty good. Bonds moving back lower today, about 1.4% lower for the TLT. That's right around 88.50. 10-year yields moved higher to around 4.54. The long bond yield around 4.7%. Dollar index up just over 1/3%. That's the UUP that we're quoting there. Looking at the commodity space, mixed. Gold actually down 1/4%. Silver prices higher, 1.4%. Crude oil lower, natural gas higher. So it really was kind of a mixed results type of day in the commodity space. Stronger oil prices certainly could mean some very different things. And part of the CPI number that was quoted on Tuesday was gas and oil prices. For now, crude oil continuing to move to the downside, and that's really put pressure on the energy sector, which has not been particularly strong here recently. Bitcoin is following through on all the volatility you've come to love from the cryptocurrency space. These last couple of weeks have been it, right? Bitcoin pushing higher now, 5.7% to the upside, currently around 37,560, we'll call it. That's up 2,000 points just in the last day. Ethereum prices pushing above 2040. So, Bitcoin had big down day followed by big up day. It is back to that sort of extreme volatility that I think we've come to describe the cryptocurrency space as one of the qualities, one of the characteristics of cryptocurrencies: excessive volatility and a lot of upside, a lot of downside movement. It's been sort of muted, right? I don't have a measure of volatility on Bitcoin, but I would argue it's probably been pretty low. And now all of a sudden it's starting to certainly increase. And days like this certainly give you the impression that there could be more upside to be had. Of course, cryptocurrency space, I would argue at this point, really waiting for more and more confirmation of more widespread access to cryptocurrencies in the form of Bitcoin ETFs based on the underlying Bitcoin directly. Looking at the sectors here to continue our market recap, consumer staples, arguably one of the more defensive areas of the market at the top. Now, Target beat earnings, was up pretty big today, double-digit percentage change. That's a big weight now in the consumer staples sector. So certainly helping the XLP to go higher. Let's not assume that it's like Hershey's and ADM and General Mills rallying aggressively. It's more of the big box retailers, which are part of the earnings stream this week. Also, look out for retailers like Ross Stores, TJ Maxx, all coming up as well here. Financials, number 2. Communication services, number 3, all up over 0.5%. Only a couple of the S&P sectors down and not by much. Utilities down about 1/3%. Energy, number 2. Then you have technology and healthcare, both up about 0.1%. So essentially flat from yesterday's close. Let's go to a daily chart of the S&P just to see how things played out today. And again, you had that big move higher. We have the gap upward. We gapped on the open up to just about 44.50, closed just under 4,500. Today we're sort of right back at that level, ending the day around 45.02, 45.03. So again, at this point, I think it's sort of the digestion day. And a lot of times when you have a big move, the immediate next day often will be sort of a pause. It's sort of a reset. Sort of see how we process those initial gains, and then we start to see what happens next. In terms of the overall structure of the S&P, things to observe as always. Look at where we're at. Look to the left. You can see the late August Early September highs are kind of in play. That was in that 4,500 to 4,540 range. We're kind of right there. We get above there, which seems to be where the trend is taking us. 4,600, not too far above current levels, just 100 points away, and that gets us back to the July high. Above there, if we would eclipse that here in November into January, that would open the door to 4,800. That's the all-time high from late 2021, beginning of 2022. Those levels are now a reasonable upside target. That's only 300 points away. That's less than 10% above current levels. So something to think about. Now, other things to think about, I was writing a note for my premium members at Market Misbehavior earlier today, and one of the things we talked about was, what's been missing in this market in 2023? During the bullish phase in the first half of the year, during the pullback in the third quarter, and now in this short-term rally, it has been a participation, a broader participation. We can measure that a couple different ways, right? We can look at something like small caps and just see if small caps are starting to participate in the upside, or you can look at breadth indicators, which essentially are more equal weighted measures telling you more about the names that are not those mega cap names, right? The S&P, the NASDAQ themselves really show you the strength of the biggest stocks because they're so dominant in the calculation of those indexes. Equal weighted indexes, breadth indicators, all tell us more about everything else. What are everything else doing? What are the other companies doing? With this week so far, we now have 70% of the S&P members above their 50-day moving average. Late October, that was at 10%. So about 60% of the S&P 500 members, that's about 300 stocks, were below their 50-day about a month ago, 3 weeks ago, and are now back above their 50-day. That shows you the strength of this short-term rally, the strength of this tactical rally off of the October low. More interesting to me as we progress through this week is the fact that one of my favorite longer-term breadth indicators, the percent of stocks above their 200-day, is pushing above 50%. Now, my basic back of the envelope, overall, are breadth conditions positive or negative over the long term? It's, are more than half of the S&P stocks above their 200-day? And if so, the conditions are good. And if not, the conditions are not good. And we went below that 50% level here in mid-September. We're now potentially getting right back above there. It's happening right now. I'd love to see through the remainder of this week if we remain above that 50% threshold. But if so, I would argue the breadth conditions have gone from very negative to bombed out negative to now a lot more constructive and now starting to be more signs of a sustained rally, or certainly the prospects for a sustained rally going forward. Just briefly on interest rates, really fun to talk to, who did we have yesterday? Pete Carmesino of Chaikin Analytics had some really interesting thoughts about interest rates, about the 10-year, thinking about that 5% level, which is pretty key. This is $TNX, which is the 10-year yield. You can see here we topped out around 5%. Again, as a reminder, these are just quoted at 10 times the yield from the CBOE. So 5%, sort of the ceiling now. And you saw that on the charts of the TLT and the AG, where they had these bullish momentum divergence indicating bond prices going higher. That coincides with yields going lower. And arguably, one of the big beneficiaries of lower interest rates over the last couple weeks has been growth stocks have room to go up quite a bit. And that's kind of what we're seeing here. So one of the things I would be looking for is if you do see rates start to turn higher, if bonds stall out, which they did today, they kind of popped, came off a bit. If you start to see that happening and rates go up, that is a bit more of a headwind to the leadership stocks that have done very, very well. And again, they have done well in rising rate environments before, but it's much tougher of a slog if that's the case. Let's finish off our market recap, just looking at some individual names here. Quite a few to talk about. We'll get to as many as we can, but I just want to highlight Target, the biggest gainer in the S&P today, up almost 18%. Good earnings win today, and that's propelling the stock higher. Again, anytime you have a gap higher, I always want to look to the left to see where have we gapped to. What's interesting to me is as we've gapped higher from around 111 up to, we'll call it 125, we finished just above 130. We're now right into this range here, June, July, August peaks. So we've rallied up to resistance, not too far above current levels. We have the 200-day moving average, and we've been generally below the 200-day for most of the last couple years for a stock like Target. So nice rally off of a very low level. That is encouraging. That's not a bad thing. The question is the sustainability above current levels. I think a break above the 200-day and holding that would probably complete that positive rotation. But now, if you've missed that initial move, that's what I'd be looking for to validate the fact that there might be further upside beyond that. Expedia is another one, big gainer today, up over 6% today. This travel tourism trade, really choppy in August, September, now October into November, moving higher. You can see Expedia gapped higher. We've talked about gaps a lot here in recent weeks. I feel like, or recent months for sure. It's been a gapping market at times, and I've often found what happens after the gap can be very telling. It can be very tough to predict that a gap is going to occur, upwards or downwards. A lot of people try desperately to do that, and sometimes are very successful. But I found, predicting that there's going to be this big gap of this magnitude is not always easy to do. But what you can certainly do is observe what happens after that gap. When you do gap higher, do we close higher, or are investors selling, or traders selling that strength, right? When you have a big gap higher and then it starts trading lower and lower through the course of the day, that tells you that there aren't new buyers coming in excited to pay way more for the stock. They're kind of taking profits. It's the opposite here, right? You see the stock gapping higher, closing at the highs, and over the last week and a half, Expedia has actually continued to push higher. Now what's happened with today's up moves really followed through above a key resistance level. Expedia making a new 52-week high again today. I think that's the real story here. The fact that we've really progressed through significant resistance. Now, the kicker with a lot of these names that have now had a very aggressive short-term run, they're all becoming overbought. And overbought on its own is not a bad thing. And you can see just a number of times just on this particular chart, we become overbought and we stay overbought for a couple weeks as we continue to progress higher. Or we become overbought and end up making a higher high not too far after. But what it often tells you is in the short term, it's probably run pretty good. And you look for when it comes out of that overbought region. That might tell you this initial big upthrust is over. For now, Expedia kind of long and strong moving to the upside. Just to finish off our market recap, I do want to address a number of the biggest sort of leading names. Names like NVIDIA, like Amazon, like Apple are testing significant resistance levels. So while it feels like we're off to the races, S&P blowing out resistance and there's nothing above but sunshine and happiness, let's reflect on the fact that some of these stocks have not broken out yet. And I think that's a lot of names, and particularly some of these growthy names. NVIDIA, with a nice November so far, is now right up to resistance right around $500 a share. Now, it could certainly eclipse that. The SMH, similar thing, kind of testing resistance, but it hasn't done it yet. And I feel much better about a chart when it's actually followed through and broken above. It had been overbought. It's pulling back today after reaching that overbought threshold. I think NVIDIA above 500 is a very compelling chart. Below there, it's a chart testing resistance. Amazon, kind of the same thing. Yesterday, we closed above the September high around 145. Today, we're actually trading back below that resistance level, so not enough of a follow-through just yet. Apple, kind of the same thing, right? Trading up to 190. This is the August peak. So, is it reasonable to expect these names that have had really good runs but testing resistance? What's kind of the general expectation? I would say short-term pullback off of resistance. Is there enough momentum to go higher? That's where you look for a higher low and an opportunity to re-engage a name that's had some short-term drawdown after a nice big run higher. But for now, not seeing enough of a breakthrough resistance to declare the thumbs up all clear on some of those leading growth names. That's our market recap for today. A lot of charts we could always try to get to. Appreciate you following along as we try to make sense of these markets. A couple quick announcements before we bring on Dave Landry of DaveLandry.com. First off, we love hearing from you guys. It's been such a pleasure to provide you with this information, create this show, and engage with all of you guys watching it. A couple of quick thoughts. Number one, we love to hear from you, particularly questions. What are you running into as you were trying to analyze these markets and actually trade successfully in volatile periods? The final bar at stockcharts.com is our email. On X, just tag us in a comment at finalbarsctv. On our YouTube channel, drop a comment to the live chat when it's available, like it is right now, or just put a comment below the video you're watching on Stock Charts TV. As a reminder, we have a second channel called Stock Charts where we have some great documentary style content, a lot of introductory content about the Stock Charts platform. So if you're looking for more Stock Charts, you know where to go. Just go to our other YouTube channel. Also, to let you know, super excited to announce our Black Friday week. And it's kind of funny, it's now Black Friday. It's no longer Black Friday, it's Black Friday week. It's becoming Black Friday month. Eventually, I feel like the whole year might be a Black Friday. But we are certainly excited to provide a really cool sale around the Black Friday period. In just about over 4 days, you can get up to 4 months free if you create a new paid Stock Charts account, or if you're a current member, you can actually add on to your subscription at this lower rate. If you are a Stock Charts member, which you all should be, and if you have enjoyed it, or if you're looking for a time to try it, this is the best price you're going to experience, and I would encourage you to take advantage of it. You can go to stockcharts.com/special. You can see the countdown to when we release it. And the moment we do, you'll be able to lock in those additional savings. And again, even if you are a current subscriber, you can lock in and push your subscription forward at the lower rate. So it's a really good time. Stockcharts.com/special. to check that out. I want to bring on today's guest, Dave Landry. Dave's the founder of DaveLandry.com, coming to us just outside New Orleans, up in Mandeville, Louisiana. Dave, good to see you. How have you been? All right?
Good to be here. Oh, I've been great, Dave. Good to see you. Am I muted?
No, go ahead, Dave. Sorry. Good to see you.
Oh, okay. Yeah, good to see you.
When we talked last, I mean, we've talked a number of times about, really sharing some of your words of wisdom. You've, again, I feel like I benefited a lot from early mentors of mine who had been trying to answer some of these questions in previous cycles. I love the opportunity that we are able to give some of our viewers to learn from someone like you who has weathered a lot of volatile periods, a lot of uncertainty, and have so far as I can tell, survived and thrived during those experiences. Today, you wanted to share with us 3 ways to stay on the right side of the market. Why is that so important to just be on the right side? Why is that foundational to how you approach things?
Well, as a trend follower, obviously you want to be on the right side of the market. And if you boil it all down, the only way to ever make money in a trade is to capture a trend. And people sometimes lose sight of that. Is it a fifth of a third or a third of a fifth? It's like, well, hang on a second. Is the market going up, down, or sideways? And the only way you're going to make any money is to get on a trend and to ride it. And of course, when the trend ends, you have to have money management in place to get you out of the way. So if you're not able to get on the right side of the trend, then you'll never make money trading.
I love it, Dave. You were preaching to the trend following choir. I just was in College Station, Texas last week talking to students at Texas A&M, and we started with establishing the trend. That was the first question we were trying to answer. So if they are watching, I know they will appreciate your 3 ways. We're starting with your chart of what we call the Landry light. This is part of our ACP platform, part of your plugin. Talk us through what this one is, and the floor is yours.
Okay, Landry light is simply lows greater than the moving average for uptrends and highs less than the moving average for downtrends. And when the price intersects the moving average, you have neither upside Landry light or downside Landry light. Now, if you look below, as you're showing, the upside Landry light is in green, and this does not count magnitude. It just counts number of days, or measure magnitude, I should say. So you can see that this has been in a trend for a very, very, very long time. As a general statement, if you have mostly green, you want to be long. If you have mostly red, you want to be short. And if it's going back and forth, you want to be out of the market, switching back and forth between red and green. And now, of course, you always want to look at the chart itself. I call my indicators, I actually call them illustrators, because they don't really indicate anything, and no indicator indicates anything. If you had an indicator that indicated where prices will go, then you know in the world, right? Well, they are useful in that it can show you what's actually happening in price. So again, if you have some green for a while, you know that you could have a trend developing. Usually about 10 bars or so is a good round number for a possible trend developing. On a downside, you might want to be a little more aggressive after about 5 bars. Now, you don't just want to blindly buy or sell, unless, like you talked about, crypto getting crazy and volatile. Unless it's something like crypto that's going straight up, you don't want to just buy because it's going up or sell because it's going down. You obviously want some sort of setup, and something simple as a pullback to the moving average, which I call a Landry-like pullback, would be a good way to get into some of these trends.
So overall, this is really helpful. Really shows the strength and the consistency of that move back over the summer, right into the peak in late July. So for now, really beginning early mid-November, we traded above the 30-day EMA, and now this is the space between the lows and the moving average. That's what's giving us the green bar. So for now, suggesting a bullish phase, right?
Yeah, well, we're getting there. I'd say let's see if we get another few more days, which we obviously will. And then, as you pointed out earlier, market is severely overbought. And one of my clients was asking, is this bona fide new buying coming in? And, maybe it is based on some of the measures you talked about. But for now, I just think it's the mother of all short squeezes. And then it's like, what happens next? Just like you said earlier with the gap, it's like, it's not the gap in and of itself. It's what happens next. So if we come back in here and retrace all the way back to the moving average, then all bets are off. And by the way, in this particular chart, I'm using a 30 exponential moving average. I do use other moving averages, but that's one of my favorite moving averages to use. I've found it does a really good job to help to keep you on the right side of the trend.
And when you're gauging sort of the overall market trend with an indicator like this, do you usually use the S&P, or are there other sort of major benchmarks you would run this on, or individual stocks? How do you think about it?
I mostly use the S&P 500, but in individual stocks, I tend to generally use the blank chart more often than not. Yeah. And then this is kind of like a secondary thing that I'll do. And in individual stocks, it works really well because sometimes especially somebody's newer to trading, they can look at the indicator or illustrator and they can see, okay, this thing's been green for a long time. Now let me look at the chart and make sure it has some acceleration, some persistency in that trend, and then look for some sort of setup like a pullback to the moving average.
Got it. Makes sense. All right. Your second way is what you call the bow tie proper order. Talk us through this one.
Okay, bow tie moving averages are 10 simple, 20 exponential, and 30 exponential. And proper order would be for uptrends 10 greater than 20 and 20 greater than 30. For downtrends would be just the opposites, 10 less than 20 and 20 less than 30. And if the moving averages are meandering back and forth, then you have no proper order because the market is consolidating during that period. Now, moving averages will have a little lag to them, but that's actually okay. Sometimes that'll stop you from chasing your own tail by using the moving averages. But you can see here, when you have downtrend proper order, the market is green. I'm sorry, red. And then when you have uptrend proper order, it's green. So we had a really nice trend, again, back over the summer. Selling may go away. Well, those guys just lost out. I was here all summer. I had one of the best summers I've ever had. It was fantastic. But anyway, you can plainly see the trend is there. Now, you notice when the trend does begin to turn, it turns yellow. And even as it's still kind of green, even though you've got like 85 bars of the proper order to the upside, if you look at price, you can see that price has begun to lose some steam, and then the moving averages have also begun to turn down. And one thing that you and I were discussing, and I learned this from Greg Morris, is that with a exponential moving average, as soon as the price closes below it, the average will turn down. So you notice that as those prices drop below the moving averages begin to turn down, especially the exponential ones. And then that slower, simple one, even though it's a faster moving average, so to speak, because it's 10 bars, that begins to turn down fairly quickly too. Right. So always look at price when you look at any type of indicator. But an indicator is a good start, something like this, a good start to show you or illustrating what's actually in the chart.
I love this example, Dave, because you're tying it into some of the seasonality. Something like sell in May, I often get a question, all right, should we sell? And the chart like this, I think, is what should give you confidence to follow the trend until the trend is no longer going up, and kind of gave a clear indication of that. When you look at it now, this certainly, when I think of it as a bow tie, this is the type of reversal that I have in mind, right? Sort of that downtrend to uptrend. How confident does this make you about the strength of the trend here?
Well, I would be much more, my favorite bow ties are off of something like a multi-year low in individual stocks, sometimes an all-time low. So like a 10-year low or even a 5-year low in the S&P 500, I'd be a little bit more excited about that. Yeah. I'm not as excited when I get one that's mid-range, but it's still useful as more of a trend indicator. So as a setup in and of itself, I'd much rather that be coming off of major lows or major highs for short. So like right now in the energy's a little bit weaker area compared to a lot of other areas. They could be in the early phases of rolling over. So we'll likely begin to see some bow ties there. And that would be a better setup. And I'd have a lot more confidence in something like that. For now, I think we're kind of overbought here, but we do have a possible trend emerging. And I kind of want to see what's going to happen with this next little correction that's inevitable. And I'd like to see whether we just come right back in or just we have a marginal correction, just enough to shake it, get everybody shaken out, and then the market takes off again. So it a lot of times as a trend follower, I noticed you said a little earlier too, you do spend a lot of time saying, well, let's wait and see. And that's what being a trend follower is all about, is you do have to sometimes wait to see what happens next, as opposed to trying to look at a crystal ball and figure out exactly what's going to happen. And just wait till that trend's established, figure out how to get on, and then have a stop in place for when, not if. You're wrong, as I often say, all trades eventually end badly.
Well said. All right, the third way to stay on the right side of the market, the TFM 10% system. Talk us through this one if you could.
Yeah, really simple system. You exit a market when it drops 10% or more away from its 50-week closing high and closes below the 50-week simple moving average. And that's your entire exit. As I've said, I think in previous shows, that's to help you avoid what Ian McAfee used to call the diaper change moment, where the market loses up to 50% or more of its value. Yes, you might get whipsawed here and there, but for the most part, this will keep you out of trouble. And this is, knock on wood, and the system's only been public maybe 5 or 6 years. But even going back 100 years and looking at a lot of testing that was not done initially, I noticed that it would have kept you out of every bear market in history. You get a 10% hit, you get out of the way, you let things shake out, and then you think about getting back in when the time's right. Now, for this system to get back in, the rules are a little bit more stringent. It was initially designed to be more of a get you out of the way type of system, but to
Sure.
get back in, you need 2 bars of Landry light. That means 2 lows greater than the 50 simple moving average. And you also have to close within 10% of the 50-week closing high.
Okay. Talk us through what's happened now, because I know we pulled back here in late October. Now, as we're
Yeah,
pushing higher, what's it telling us about the market here?
yeah, I'm kind of shocked because this could be the mother of all whipsaw filters. If you go back 3 weeks, that red bar down into that 10% zone, you'll see that that was a sell signal.
Yeah.
And I got out of the way in certain. I have very little longer term funds, but I do have a few here and there. But I did get out of the way just to keep it a long story short. But I got out of the way, and then I'm kind of surprised we're going straight back up. But that's fine with me. Greg Morris once said, whipsaws are frustrating, bear markets are devastating. You could survive frustration. I'd rather the market just go straight back up and get long again, than worried about that. And one more point too, a client pointed out a few weeks back, and that's why I added these zones to this chart.
Yeah.
Once you get 5% or more away, that's kind of like a caution zone, and he's more of a get out of the way kind of guy, even quicker. And he's found that in his research, you're better off getting out of the way at 5%. I did the same research. I found that you will get a lot more whipsaw if you do that, but it does kind of let you know that, hey, we're getting into this caution zone. Market could be in trouble. We need to start thinking about getting out of the way.
This is awesome. And what I love about this, I was taught all large losses begin as small losses. So a system like that just keeps your losses manageable. Just that simple exercise. I mean, just preventing the climactic declines. That's always part of the game. This was awesome, Dave. Any final thoughts here? This was really, really helpful.
Well, one thing I would also recommend is before using any indicator whatsoever is look at the net price movement. Is the stock higher, lower, or market than it was a week ago, a month ago, or years ago even? I had a neighbor call me recently. He was frustrated because his financial guy hadn't done anything in 2 years. And it's like, well, if you go back 2 years, look at something like you look at the Russell, you look at the S&P 500. On our net basis, we haven't made a whole lot of progress over that period of time. Now, that's a little bit of an extreme period, but as a general statement, you want to look again over a period of weeks to months and maybe even a little bit longer to see if you're making any progress on a net basis.
I love that. And thinking about the trends and how they're changing in the markets. Dave, this was awesome. 3 ways to stay on the right side of the market. 3, I mean, honestly, very simple but powerful ways of just making that initial assessment of the trend. I hope we all can apply some of those in our trading. Good to see you, Dave. Best to the family there, and we'll talk to you again soon.
Thank you, Dave. Nice to be back again. Thank you.
That's Dave Landry. Dave's the founder of DaveLandry.com, and I love some of these discussions. Just really a lot of wisdom in there. And again, that initial assessment of trend and some of these basic tools you can apply to the markets to focus on where the trend is and when it's changed. Great way to manage risk. Great way to make sure that you are following the overall trends in the market. A brilliant take there, as always, by Dave Landry. We got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Talking about breadth and really the improvement in breadth during our market recap, we talked about the surge higher in breadth indicators. Now, I think already since the October low, I feel like we've gone through a couple sort of brief phases. That initial phase is, all right, we're really beaten down. The S&P's undercut its 200-day moving average. We're down to about 10% of the S&P members above their 50-day moving average. We're really bombed out here. So not surprising to get a nice short-term bounce off of that. Now we've continued to see further appreciation. What's happening is that the breadth indicators are now going much more positive for the short-term breadth, but also the longer-term breadth, right? So the 50 stocks above the 50-day, the McClellan oscillator, all giving that bullish signal off of the lows. Now I'm starting to see some of the longer-term breadth indicators. Now it's not all beautiful sunshine just yet. I would say still the advanced decline lines are not particularly bullish. They're neutral at best, but I would argue still pretty weak. So I still think a lot to prove. I think some of those names eclipsing resistance levels, how we handle this overbought condition. I think Dave Landry made a great point about we've now rallied a ton. what's next, right? Now that we've had this reaction to CPI, what's next? What's that catalyst that is going to propel stocks higher? And what will those charts look like if we're able to get above resistance? That's still very much an open question. But for now, I'm encouraged by breadth conditions certainly continuing to improve. Chart number 2, the TLT. This is the bond ETF, looking at bond prices. We talk a lot about the 10-year yield, kind of flipping that chart over gets you a chart like this, which is the TLT. We've talked about this bullish momentum divergence that happened in mid-late October as we had lower lows in price and higher lows in momentum. Now we've rallied back up. What's interesting to me is rates have come down a bit. This is when the 10-year is hitting 5%. Now we're coming off of that level. But if you look, the RSI has bounced back up to around 60. Now, when the trend is bearish, like you were here in 2022, these rallies that you will see will often get the RSI right up to around this level and then rotate lower again. And we're kind of right at that point. So if this still is a bearish phase, we're kind of right at that point where you'd expect the TLT to roll back down. You'd expect rates to come up. And I would argue that puts some headwinds for rates. Or excuse me, puts headwinds for growth stocks that tend to benefit from lower rates. So keep an eye on the chart of the TLT, see if it's able to break above 90 and if the RSI is able to get above that crucial 60 level. Finally, looking at 2 leading growth stocks, Apple and NVDA, number 2 and 3, if I remember right, in the XLK at the moment. Both of these stocks are testing key resistance levels. Microsoft, same thing. All these names that have had these really good runs. Sorry, Apple, Amazon was another one we pointed out earlier. So it's interesting when you're looking at just the last 6 months or so, we've rallied beautifully, right? Both of these stocks made a new swing low. Both of them rallied very, very nicely and now testing the lows or testing the highs from late August, early September. Now we've stalled out a little bit potentially, and I think the question for these leading growth names, can they power not just to resistance, which they've done, but can they power above resistance? Do additional buyers come in and push it higher? If this is a short covering kind of rally, that usually runs out of steam, and then you decide to kind of get back to normal. We'll see if these key names can get above key resistance. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Dave Landry of DaveLandry.com joining us from New Orleans. Don't forget to like this video, subscribe to our channel while we're here. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.